What's up? RIVN just dropped Q2, and on the surface it looks like a turning point: gross profit positive, losses shrinking, production way up. But there's one line in this deck that changes how you read the whole thing. The report landed after the close, so the market hasn't voted yet. Today we just read what's actually in it. Quick disclaimer, not financial advice, purely education. Let's go. First, real credit. This is the best quarter RIVN has put up, and it's not close. Straight from the deck. Deliveries, 12,194, up 14%. Production, 12,613, up 111%, though that's against a weak quarter last year when they were retooling. Revenue, $1.66 billion, up 27%. And gross profit, $179 million, versus a $206 million loss a year ago. That's a $385 million swing. And look at the gross margin row across 5 quarters. Negative 16%. Then 2%. 9. Now 11%. That is a clean, consistent trend in the right direction, 5 straight quarters of improvement. Adjusted EBITDA, basically operating cash profit, improved from negative 667 to negative 379. Still a loss, but 288 million less of one. Okay. But RIVN is a car company. So the question that actually matters, did they make money selling cars? Let's go look. This is the automotive segment page, and here's the answer. Automotive gross profit, negative $36 million. Gross margin, negative 3%. Now, a year ago that number was negative 335 million at negative 36% margin, so the improvement is massive and real. But it's still below zero. As of this quarter, RIVN loses money on the vehicles it sells. So if the car business lost 36 million, but the whole company made 179 million in gross profit, where did that come from? Here. Software and services. 515 million in revenue, up 37%, and 215 million of gross profit at a 42% margin. 42%. That's a software business inside a truck company. And most of the growth is vehicle electrical architecture and software development work for the Volkswagen Group joint venture, so it's largely one big partner paying RIVN for engineering. Now do the arithmetic. Software and services, plus 215 million. Automotive, minus 36 million. Add them up, 179 million, exactly the company total. Which means 100% of RIVN's gross profit this quarter came from software and services. The vehicles contributed nothing. Actually, less than nothing. And there's one more asterisk on the automotive numbers, and it's a big one. See that dark segment at the top of the last revenue bar? Those are regulatory credits. RIVN sells emissions credits to other automakers who need them. It's essentially free margin, no cars involved. The deck says credits added $103 million year over year. Look at the chart, automotive revenue was $1143, but excluding credits it was $1037. So credits were about $106 million this quarter, versus roughly $3 million a year ago. Which reframes the headline. Automotive revenue grew 23%, but strip out the credits and the actual car revenue grew about 12%. And remember, the segment still lost $36 million even with $106 million of credits sitting in the revenue line. The deck also credits a tariff refund receivable in that improvement. Lesson: always ask which part of revenue came from selling the product. Next, the clock. Because gross profit is only step 1, you still have to pay for everything else. Same table, lower down. Gross profit, 179 million. Total operating expenses, 1,015 million. So research, development, and running the company cost roughly $1 billion in a quarter where gross profit was 179. Free cash flow, actual cash left after operations and building factories, was negative 849 million. And cash fell from 7.5 billion a year ago to 5.3 billion. Which raises the obvious question. If you're burning cash like that, who's funding it? This page. Pro forma liquidity of 7.2 billion, but read how it's built. 5.3 billion of cash, plus 1.3 billion they just raised in early July by selling 86.25 million new shares at $15.50. That's dilution. Existing owners' slices got smaller. Then targeted capital, a $1 billion Volkswagen loan, $250 million from Uber tied to autonomy milestones, and a Department of Energy loan of up to $4.5 billion, conditional.
RIVN has runway. It's just heavily partner and government funded. So what was Wall Street looking for going into this?
Analysts expected roughly $1.5 to $1.58 billion in revenue. RIVN came in at $1.66, so a beat on the top line. Ratings are a hold consensus, 8 buys, 6 holds, for sells, average target around $18. RIVN had already raised its 2026 delivery guide to 65 to 70,000 vehicles. And options traders were pricing about a 10% move either way. Which tells you nobody was confident about the direction. So, both sides, honestly. The bull, gross margin has improved 5 quarters straight, R2 is finally in production and reviewing well, software is a genuinely high-margin business, and the loss per quarter keeps shrinking.
This is what a turnaround looks like early.
The bear, the cars still don't make money, the company profit relies entirely on software plus emissions credits, they burned $849 million in a quarter, and they diluted shareholders at $15.50 just weeks ago.
Both readings come from the same deck. Let's land it. 5 things to remember.
1. Gross margin hit 11%, the 5th straight quarter of improvement, and that trend is real.
2. Automotive gross margin is still negative 3%, they lose money per vehicle.
3. 100% of gross profit came from software and services, not from cars. 4. Regulatory credits added $103 million to revenue growth, free margin that isn't from selling vehicles.
And 5. Free cash flow was negative $849 million, so the clock is still running. The direction is genuinely encouraging. The distance left is the debate.
One more time, this was education, not financial advice. Do your own research and talk to a licensed advisor before risking real money.
If you learned something, like, subscribe, and I'll see you in the next one. Peace.